Good morning and welcome to Trading Hour. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Reema Tendulkar. With me is Hormuz Fatakia. And Hormuz, you must say, it's a fairly mature reaction coming in from the markets. A bit choppy. The first tick was in the red. I think the Nifty straight away opened down about at 24,220, instantly recovered back, and then it's been a little bit up and down. But as we speak, at 11 o'clock, Nifty Sensex down close to about 0.1%. Mid-caps are recovering from the 2% fall that we had yesterday. Watching the geopolitical developments, we just heard the Ministry of Defense press conference, but so far, market is not pricing in any sort of an escalation going by the price action. And, what's helping on the sidelines is the fact that both domestic and FPIs are buyers in the market. So the flows have been very strong, and that's propping the markets as of now.
The flows have been very strong. I was just reading up in the morning that 44,000 crores is what the FIIs have pumped in over the last 14 trading sessions, where they have been net buyers, and 14 straight sessions as well. So that is some support that's coming in from the foreign investors as well. Domestic investors, of course, they have been the ones that have been doing the heavy lifting all along when the FIIs were the net sellers in this market. But yes, as Reema was just highlighting, a very mature reaction to the ongoing escalations between India and Pakistan. There, absolutely at the flat line.
Let's call it retaliation instead of escalation.
Of course, yes, retaliation, of course, in reaction to the deadly attacks in Pahalgam last month. So, of course, the index is at the flat line, but then you can't take away from the fact that there are a lot of earnings reactions that are continuing. There are plenty of earnings that are to be reported today as well, particularly from the broader markets. And you take a look at BSE, that is now up 8% as we speak. So that is an earnings reaction that's doing well for itself. Piramal Enterprises is doing well for itself, 6.5% higher. But one that's standing out today, though, is Paytm. It's 7% higher in today's session. And of course, the management commentary also reflecting the fact that there was a net loss, yes, but then of course that was because of some exceptional items, and they are well on course for operational profitability and net profitability as well in FY26. A couple of price target raises also coming in for Paytm. So 7.75% higher there, almost at 900 now is Paytm.
So there was one important thing in the conference call about the merchant discount
the MDR,
rate,
yes.
the MDR, which is currently zero on UPI charges. So Paytm doesn't earn anything. But on other forms of payment, like credit card, you have an MDR rate of 2.5%. And I think what the management said in the conference call is that regulations on MDR on UPI are likely anytime soon, and they could see conservatively a benefit of about 7 to 8 basis points. So that's going to be a big catalyst that the street is going to be watching when it comes to Paytm stock. Clearly higher, 8% up. But Bank of Baroda had an operationally weak Q4. Yesterday, stock was down 10%, and today as well, it's down nearly 0.5%. No improvement in the stock price. Slippages remain elevated, and the street was disappointed by the NIM's performance. Sequential decline in the net interest margins, and margins have come in at a multi-quarter low. CNBC-TV18's Lata Venkatesh spoke to the MD and CEO of the bank, Debdatta Chand, and began by asking him about the slippages and the way forward. Listen in.
On asset quality, we have one of the best quarter we have for last many years now. On the slippage side, let me address that. On a full year basis, the slippage has been much lower. At the same time, the recovery has been much higher than the last year. And specifically coming to the quarter ending Q4 of FY25, the slippage is 2,800 crore, which is equally the same like the same slippage in the last quarter of last year. And sequentially also, the slippage is only higher by only 300 crore. Wherein the recovery for the same quarter to quarter, let's say Q4 over Q3, it is in excess of 300 crore incremental. So in that way, slippage is much under control. And we have been saying that on the asset quality, as I said, one of the best quarter. The GNP has been trending downwards for last many quarters and many years now. The net NP is down from the GNP is 2.26, is one of the best in the 13 years now. The slippage ratio, we had given a guidance of 1 to 1.25, whereas the slippage ratio for the full year is 0.78. And as compared to the last year, from 0.99, it has gone down to 0.78. The credit cost is all-time best now. The full year is 0.47. So I think asset quality-wise, there should not be any concern with regard to any slippage. The bank has the best of asset quality for Q4. The 300 crore of additional slippage, no way any impact to me, because the incremental recovery has been much higher than that. So in that scenario, this is not a concern as far as the bank is concerned.
I take your point that the investor community will be reassured by what you're saying. But net interest margins was perhaps the other talking point. in the market, coming down to 2.86. That's almost 10 basis point fall from quarter ago, and of course from year ago it's looking like almost a half a percentage point fall. Is this the lowest? Do you see it improving?
See, we're given a guidance to the market for the full year at 3 to 3.10, right? And in that scenario, the global NIM is at 3.02.
Okay.
And the domestic NIM is at 3.18. And since we run a large international book where the margin is less, so the global is slightly below the domestic NIM. Saying so, if I look at my the NIM on a quarter-to-quarter basis, the deposit actually, I'm carrying a rate sensitive liability. I always said that my liability should react to the market in terms of the elevated cost. And that precisely happened. So going forward, the outlook is that I think the cost of deposit has picked out as far as the Q4 is concerned. There are two scenarios we are migrating while migrating to the Q1 of this year. That there is a rate cut or repo 50 bps that happened to the market in that way. At the same time, the liquidity has changed from a deficit to surplus for Q1. So considering both the scenario, I don't think any further pressure on the margin going forward. Okay. Rather, we have come true to our guidance in terms of the margin guidance 0.1. And for a full year NIM of 3.02, I think I am on the top quartile in terms of the large PSB peers. Okay. So there are very few maybe higher than me. So
but the overall NIM of 2.86 will be bottoming out. Do you think you will go above 3 in your overall NIM, that is domestic plus international, in the current quarter, April, May, June?
As far as quarter to quarter, yes, it has bottomed out. But let us also be mindful of two scenarios when you look for the full year FY 25-26. One is a case where the repo rate cut has happened, so as the BRLR has gone down, right? At the same time, the deposit we have moderated on the wholesale deposit that we see there is a cost moderation therein. On the retail, we reduce the peak rate from 730 to 710. So, but again, fresh deposit can only contract reprice at a new rate, not the old deposit. So there will be some lag effect on that. So the moment you migrate to Q3 or Q4, I think we'll catch up to a normalized margin of around 3% going forward.
Okay, I get that. Will your advances continue at nearly 13%? Many banks have guided for a lower advances growth.
We had a very strong, as you said, very strong advance growth last year. Actually, the domestic advance at 13.7%, and the global is at around 13%. We had given a guidance of 11 to 13, but we are again above 13 in that way, right? So that's point one. Secondly, my sense, retail continue to grow at 20%. One numbers you would have seen, the MSME and agri growth, the growth for March 25 is 14.2%. So scenario when the liquidity back into the market now, I think we can upsize the growth by 1-2% more rather than maintaining the growth. So I'm quite hopeful of, upsizing the growth going forward.
So you're guiding for 14%?
We'll give a guidance on that matter, but we retain the guidance at 11 to 13, but we'll definitely exceed 13%.
Okay. Oh, that's good to hear. Now, let me come to the slippages, or rather the credit cost part again. With the recent decision of the Supreme Court in the Bhushan Power case, you have an exposure, I think, over 1,000 crores to Bhushan Power, which you got from JSW Steel. What happens to it? Have you to return the money? Will that alter your provisioning credit cost in any way?
See, as you said, my exposure is not significant. It's less than even 0.2% of my corporate book. So exposure is quite less. So it's a judicial process. So there is sensitivity surrounding the process. So let us respect that for the time being. For us, actually, adding any comment at this stage would be slightly premature.
Okay. What exactly is the exposure, sir?
And normally bilateral we don't disclose, but it is less than 0.2% of the corporate book.
Okay. Okay. No, I don't know if you can comment on this much. There is a point of view that even if this money has to be returned by the banks to JSW, the liquidation of the plant, liquidation of the company, Bhushan Power, will bring back maybe even more. There is a point of view like that. Would that be one way to look at it?
Slightly difficult because, again, the entire process is being guided by legal advice on the matter. So, actually, as a COC, I think and the COC would take a call based on all these factors therein. There are legal counsel, advising on the matter, and possibly going forward, we'll hear more on that.
Management there of Bank of Baroda, they're pretty much the accident of yesterday's trading session after its numbers ending almost 10.5% lower. The stock, though, has recovered slightly from the lows after that management comment, after the interaction there with Lata. But just before we take that break, just pull up the India Wix. And at one point, the Wix was up close to levels of around 20. That has seen a sharp fall from the highs after the briefing that has taken place from India with regards to the retaliatory attacks that have taken place. The Wix now down around 3% compared to earlier levels that were touching close to 20. So keep an eye out on the Wix as well. Take a short break. Up next, we'll be joined by the management of Newgen Software to discuss their results and the road ahead for the company. Stay tuned.
Welcome back. Newgen Software recently reported their Q4 numbers. The company saw the net profit surge nearly 22%. Margins expanded. The top line growth was close to about 14%, but that is lower than the 20% run rate that the company has been enjoying. In fact, Q4 was a 14% revenue growth. Q3 was 18%. And prior to that, the company's top line growth used to be close to about 20%. In fact, even higher than that. Virender Jeet, CEO of Newgen Software, is now with us on the show. And just to put it in context, numbers came out on Friday during market hours. Virender, thank you very much for joining in. First, if you could talk about your top line growth. There seems to be a bit of a slowdown, 14.5% in Q4. What led to the weakness compared to prior quarters' historical growth rates? What can you guide in FY26? Can you maintain a 20% sort of a run rate or do better?
Good morning, and thank you for having me out. We have constantly grown at 20% for many years. Almost from 2013, it has been the trajectory apart from a couple of years. So there's just to look at in the near future, there's no reason why we should not be able to maintain that. Having said that, looking at what has happened over last 8 quarters, also I think last year we had grown at almost 40% on Q4. I think it was a very heavy base. For the year, we did grow at 20%, which is in line with what our expectation is. We did expect to really grow by a few more percentages, but I think we had some amount of deal slippages and other things, which normally happens in the business. We closed a good year. In fact, as you rightly said, overall we grew at 20%. Our margins expanded. We had 40% growth on license, which is actually determinant to our future growth because the downstream revenue kicks in. And also we had a phenomenal 62 deal wins and the new logos, not only the deals from existing accounts, but especially from the new ones. And I think it was broad-based. And US fired. We did 20% growth out there. APAC fired in a big way. I think it has been healthy. What has happened is, as we are slightly increasing the number, the lopsidedness of revenue growth, which used to be happening, the Q4 and Q3 used to be almost around 60-65% of our business, has now moderated to around 55% of our business, which is, I think this phenomena will continue. We may have higher growth quarters in Q1, Q2, because relatively the numbers of Q1 and Q2 are lower. And Q3, Q4 may not be at the same percentage point, but at an annual level, we'll continue to maintain the growth momentum.
Okay, so you're saying that 20% growth run rate should continue FY26 onwards, as you did in FY25. The Q4 moderation in the top line was on account of a higher base and certain deal slippages, which are normal. It's not to do with the macro uncertainty that we're seeing. Is that correct?
Yeah, absolutely. I think there's nothing, as of now, we don't see any uncertainty in the business or nothing is coming up on the radar.
Virender, good morning. Thank you for joining in. Now that you're saying your FY26 will also continue to grow at 20%, but what about your other businesses, right? Because the banking vertical growth slowed to 10%. Your bookings for the full year grew at only 10%. In FY24, they were up 23%. What is the current situation that you are witnessing on the ground? I know you mentioned that you are not seeing any uncertainties as of now, but are you seeing any delays in spending, delays in decision making, considering all the uncertainties that are prevailing around the globe right now?
See, the way we see our business, we are pretty diversified. This is one thing very unique to us. If you look at our businesses are quite evenly spread around India, Middle East, Africa, US, and APAC. So a single territory pain or a kind of an uncertainty we don't see the impact that drastically at other companies do. The other thing is also it's diversified across three verticals now. Though banking is a larger part of that, but also the insurance and government are becoming sizable. And then if you look at the client concentrations are very, very low. I think it's quite spread. We do business with almost 500 clients and nothing is very materially big. We still are, a kind of a relatively smaller company. And typically our deals are more tactical and strategic. They're not really large strategic deals for the clients where they could have an impact of non-decision making. We still, they're championed around a cause which is very urgent for an enterprise. And we have seen both an upturn where we are servicing growth or we are servicing optimization or cost. We have relevant use cases for in the market. I don't see any challenges as of now. But having said that, right now the levels of uncertainty in the market are very, very different, which nobody has seen, and we don't know how the whole market will shape. Right now, we don't see those things coming to us, but I think we'll have to wait and watch.
Okay. Your deal bookings are, I think, at 1,664 crore for the full year. That's a growth of 10%. And this is lower than the 20% or 20% plus growth that you had in the prior quarter. What's the reason for that? And will this not make achieving that 20% growth challenging for you in the subsequent year?
Yeah, I think this is a good indicator, but not the only indicator. Most of our, the way we look at our business at the beginning of the year, almost 70% of our business comes from the contracts which is either in renewal stages or which has been already booked, which we call business in control. We are roughly at a business in control number of 1,250 crores, which is almost 20% up than last year. And then we do have to get new deals and new logos and new license wins this year, which is not going to be significantly different than what we have done last year. So while the order book of a previous year is an indicator, but it's not the only indicator. More the outcome of this year will determine about the sales which happens in this year and the license revenue we realize in that year. Our Q1, Q2, Q3 order books were leaner. You're absolutely right. But Q4, our order book on a year-on-year grew by almost 27%. So I think there's a change in that trajectory also. And we think in this year, we should be able to build the businesses and realize the revenue on that front.
Okay. US, your investments in US seem to be yielding results now. I think your US revenue growth was about 39%. You added 10 new logos in US across various sectors, banking, healthcare, insurance segments. When will that, even the deal wins were fairly strong. What is the outlook on US, the kind of growth? How much will it contribute? What is the growth that you anticipate in FY26? And when will the deal wins, one in US, flow through into your top line? When will they start getting executed?
You're absolutely right. I think we have been investing for a very, very long time, and it has been a hard work. And I think we have built a successful customer base of around 70 customers in US now. And last quarter, you're absolutely right, was a good quarter for us. We had more than 10 wins, and these wins are typically in larger accounts. So we have pivoted from smaller accounts in smaller banks and insurance to larger entities. A lot of our deals, the revenue starts flowing in 1 year to 2 years. That's the time frame, and the deal gets almost consumed in that kind of a thing. But since our downstream revenues from these deals also are about renewals, expansion of licenses and those things, they will continue to grow as accounts with us. Last quarter, from the number point in terms of the number of deals, has been the first quarter we have. I think we'll have to wait and watch for a few more quarters to see how much of strong base and trend we have established. But surely our investments in insurance vertical and health, which we started around 12, 13 months back, have started yielding results. Now we have got successful wins in both the areas. And banking, we keep on, again, grinding and getting few more deals out there. So if all three fire, then we'll always keep on repeating such performance. But I think we'll have to wait and watch how permanent it is this. We think the US should lead the future growth of the company. So predominantly, I think we expect that in next 2-3 years, US becomes the larger market share where we come. But I think it's work in progress and we'll have to.
How much would US contribute?
You see, generally what I think right now, the US is roughly around 22-24.5% of our revenue. But while as globally the spend for our kind of areas, US is around 60% of that. And right now our sizes are small, but as our size becomes more close to a larger company, the US should be in the same range of almost contributing 50% of our revenue.
All right, Virinder, we'll hold you to these numbers. There are still a lot more questions to ask you, but running out of time. Thank you so much for joining us today. Wish you good luck for the rest of the year as well. There is a management there of Newgen Software, confident that the US could become the primary contributor to their revenue in the next 2 to 3 years. Take a short break. The management of JBM Auto joins us on the other side. Stay tuned. Welcome back. Continuing with earnings conversations, then Nishant Arya, the Vice Chairman and Managing Director of JBM Auto, is joining in now to discuss the road ahead for the company. Nishant, good morning. Thank you for joining in. You know, it's a marginal deviation, but you had guided for 6,000 crores of revenue in FY25. You've ended at 5.5. But what are you penciling in now for FY26 with the kind of situations that you are facing on ground right now?
No, I think we are gunning towards again the 6,500 crores, 6 to 6,500 crores revenue for FY26. As you would see, the EBITDA percentage has grown substantially, almost 1% from FY24 to 13.3%. And clearly, we are seeing that today the kind of market scenario for e-mobility is growing substantially, and we are having a very strong order book. Just recently, our tie-up and alliance with Hitachi is also going to play a critical role in enhancing analytics and performance of our EV products with their global technologies. And I see that now with the UK-India FTA, a lot of new market opportunities will also open up for Indian companies like us who are very well poised with the whole EV ecosystem.
I'll get to your UK exposure in just a bit, Nishant, but just to confirm numbers, you mentioned 6,000 to 6,500 crores for FY26, if I heard you correctly?
Yes, yes.
So 6,000 is what you were projecting for FY25. You made 5.5. Now you're projecting 6 to 6.5 for FY26.
Correct.
Right. So, and now coming to the FTA bit, do you have any exposure to the UK market currently? And if not, then how do you see this as an opportunity for a company like yours for the UK market?
No, I think UK market will be a very important market going forward. I think until now the import and the tariff barriers were a big concern, but automotive sector being in the 99%, which will be tariff free, that will be a big game changer, and having a right-hand drive product from India, which we are already looking at for exporting to new markets, I think this would be an ideal market for us to enter.
Do you have presence in UK?
No,
Right
we don't
now?
have any presence in UK as of now. Yes.
Okay, but are you planning to?
Yeah, now
say in the next 1 or 2 years?
definitely we see that we would be looking to enhance our presence in the UK. We already have presence in other parts of the world, like in Middle East, Africa, in Asia Pacific, and Europe, but not in UK.
No, so how long will it take for you to establish a presence?
I think
Can you get some revenues in FY26? Because I'm sure there is an entire procedure which goes behind this.
yeah, definitely. I think we would be looking to see how we can create business opportunities in this year and realize them in the beginning of next year.
Since we are on this subject, Nishant, could you also share us a breakup of your domestic to exports breakup in FY25? What are you targeting for FY26? And what's your take on the overall export market in the geographies that you are present in? How much do you plan on growing it this year?
No, so in FY25, we were 95% plus domestic and close to up to 5% exports. Now this year, we're trying to see how we can double it up to close to 10% exports.
So you want to take it? Yes, please go on. Please go on.
Yeah, and primarily in Europe, Asia Pac, and Middle East, Africa.
So you're planning on doubling your export share to around 10% in FY26 is what you're saying?
Correct.
Right. Okay. And what about your launch pipeline? Any new launches that are in the works anytime soon?
Yeah, this year we are planning to launch 4 new products. And we'll be talking about it soon in the next coming months.
Okay. For your platform, JBM EcoLife Mobility, that houses, I think, the gross contract special purpose vehicle, you were looking to secure some more funding. Is that correct?
Yes.
Okay. So where are we? Because I think you raised money in September of last year for the
Right.
EcoLife platform, but I think you were scouting for some more money.
Yeah, so
So
we
where-
have raised money from ADB,
Correct.
AIIB recently as well. So that has been concluded. Yes,
That was in September of last year, right?
also in
From
month of
ADB?
March. So also in month of March, we have closed a few more rounds with ADB and AIIB.
And how much was that?
So we are starting with about 200 crores, and we'll be growing further as new projects come along.
Okay, and how will this change your, at the consolidated level for JBM Auto Limited, JAL, the listed entity, how will this change the debt profile? Because now you need to infuse less money into the platform. So
No,
what
so
will
we are
those-
trying
yeah.
to see that the platform becomes self-sufficient. So platform becoming self-sufficient is very important because then it can generate cash from its existing SPVs and new SPVs and fuel its own growth for the future.
Nishant, is the OEM business, the segment performance, does that remain a cause of concern for you? How do you see that shaping up this year?
No, that is not a challenge because as you see, even last year, the OEM performance profitability has increased multifold. And definitely in this year, we would be looking at higher volumes because the first half of the last year, due to different elections and different changes in different multiple states, things were a bit slower. So I think now things are on the right track with very strong policy framework and deployment plan. So from the beginning of this year, the things are in the right direction.
Nishant, very quickly, one final question. There was a lot of M&A activity taking place in your field right now. Were you in the fray for SML Isuzu? Just to hear it from you. And are there any inorganic plans, growth plans in the pipeline for FY26? Are you looking at something?
No, so as I said that I would not like to comment on market speculation even earlier. So we were not looking at SML, and definitely as something comes up which we are looking at inorganically, we'll share with you.
Has something come up?
No, not right now.
Not yet. All right, Nishant. Thank you so much for sparing time and joining us today. Wish you good luck for the rest of the year as well. The management there of JBM Auto. Take a short break. The markets continue to remain around that 24,350 mark. We discussed the road ahead for the Indian equities with Mihir Vora from Trust Mutual Fund on the other side. Stay tuned.
Welcome back. Mihir Vora from Trust Mutual Fund is now joining in to navigate the market volatility, the headlines, and what investors should be doing with their money in such a situation where tensions are running high between India and Pakistan. Mihir, thank you very much for joining in. So long-term history tells us that generally, even when tensions are high, it's not that there is a material damage to the markets. We generally tend to move on. But in the near term, as we navigate the here and now, what's the advice that you're giving to clients now?
So,
I think you're on mute. Yeah, go ahead.
yes, hi. Can you hear me?
Can hear you loud and clear.
Okay, great. So obviously markets will remain volatile around such events. But to some extent, since it's been a couple of weeks since the terrorist incident happened, the markets have been expecting some action. Last time, I think in 2019, there was a couple of months of gap between the event and the action. This time around, it has happened much faster, I guess. So to that extent, partly such action was expected. The timing, of course, was not known. So, I mean, once you're past the actual event, probably the market start looking a bit more forward. Now, I think the ball is in the enemy country's hand to basically take a call on how much they want to escalate the situation, because I think India has done what it needed to do, and probably there might be some more going forward. But more or less, I think the big event is past us. The markets have been actually kind of discounting this, and in spite of knowing this, impending action to some extent, the markets have been quite stable. What has happened, I think, is over the last 20 years, we've gone through a learning curve. And the big picture is that even though such events happen, they have not really escalated into a wider conflict. So that's the learning over the last 20 years. And second is that the Indian economy itself has grown so large that even if there is some skirmish, the economic implications in the long term are not that significant. So I think these two learnings are very significant over the last 20 years. And the third portion is, of course, the fact that both FII flows and domestic flows are quite robust in the last few weeks. Domestic flows have been robust for the past few years, which was not the case 10 or 20 years ago. So I think the bottom line is that the Indian investors have gone through this learning phase. Domestic flows are strong, and basically, unless this thing escalates into a wider conflict, the markets are able to absorb such shocks.
Mihir, good morning. Thank you for joining in. The other big factor that has been the determinant of the market moves have been earnings. And there was a lot of fear that the fourth quarter earnings may also turn out to be as bad as the third quarter was. But that has not been the case, at least for majority of the companies that have reported so far. Do you see this improving further as we go into FY26? Because then the low base kicks in as well, and that acts as an additional kicker to move the market higher.
Yes, that's been our base case in any case. But so far, the earnings season has been a mixed bag. I wouldn't be very euphoric about it so far. At least the large caps have not done too much in terms of earnings surprises, but they haven't been major disappointments too. So I would say it's been a mixed bag with single-digit kind of earnings growth expected for the March quarter that just went by. Going forward, as you rightly mentioned, there is a low base, especially in the June and the September quarters. The base is far lower because we saw that the government spending in the quarter of June 24 and September 24 really was low, and there was a big break, I would say. So that base should help us going forward, and that's been our base case going forward. Large cap earnings growth expectations are still probably high single digits. Small cap earnings growth expectations are a little better at about 15%, and I think so far that assumption still holds.
So Mihir, are you all fully invested at Trust Mutual Fund?
Normally, we tend to be fully invested. We don't keep more than 5 to 10% cash, and that's the current situation also.
So incremental money that's coming your way, where are you deploying it? So tell us the actions, the portfolio changes that you all did in the month of April.
Broadly speaking, we haven't done too many changes in April. We had done some changes in Jan-Feb, essentially shifted a bit in favor of larger private sector banks and NBFCs, added a bit to some of the cyclicals again, which we have trimmed a bit. But apart from that, no major changes, I would say.
The two themes, Mihir, that I wanted to ask you about, where there is rising competition. You just saw a downgrade coming in for DMart earlier this morning over this rising competition. So how do you approach this retail / hyper-local retail space? And you can combine that with the quick commerce players as well. And the other one is the wires and cables space, where after the foray from Ultratech, from Adani, the numbers that have been reported so far by the incumbents have been fairly resilient.
Sure. So on the quick commerce space, we have some exposure because we do think it's a growth segment. However, there has been disappointments in the last couple of quarters. The assumption was that we probably may not see as intense competition in the 10-minute delivery, 15-minute delivery space. But I think companies are not taking any chances and investing for the future, so to say, which is depressing margins to some extent. So it's kind of a mixed bag. We're not taking a big call either way. We have some holding. We are sticking with it. As far as the cable space is concerned, there is a concern of competition. But I think beyond the point, maybe valuations are catching up, though we don't have much exposure to this space. But the sector has been lackluster in terms of earnings growth for quite some time. And maybe the base effect is now catching up, I would say.
The alco-bev sector is in focus today on the back of the UK FTA. Is this a sector that you have interest in? Is it a part of your portfolio? Any stocks here?
Yes, we do have some mid-cap exposure in the alcohol space, but that's more because of the fact that we do believe that premium consumption items will continue to grow well, and spirits are of course to some extent discretionary, and we have seen the industry growing more because of premiumization, so which fits in well with our thesis of premium consumption. So we have some exposure there, yes.
Mihir, pleasure having you as always. Thank you so much for sparing time and joining us today on the show. Mihir Vora there of Trust Mutual Fund. Take a short break. Continue with earnings conversations. Amit Agarwal, the Executive Director and Group CFO of DCM Shriram, joins us on the other side. Stay tuned. Welcome back. Continuing with earnings conversations, then we're now being joined by Amit Agarwal, the Executive Director and Group CFO at DCM Shriram, to discuss the road ahead for the company. Amit, good morning. Thank you for joining in. Get it straight off the bat. What are the kind of growth targets that you are penciling for FY26 now, considering the situations that are developing both in the country as well in terms of the economic growth, of course, and the geopolitical tensions overseas when it comes to tariffs and all of that? What are the kind of growth targets for FY26?
Yeah, I think for us, we've completed our capital expenditure programs in chemicals. A large part of it has been completed, which happened in the current financial year, the year gone by. And in this financial year, also, we are completing a couple of projects. So what I feel is that a lot of growth is going to be volume driven. The project which we completed last year will have full year impact this year. Some of the projects which we are completing in early part of this year, they will have an impact this year and next year. Similarly, next year also, early next year, we are completing some projects. So it is a continuous pipeline of volume growth that we're looking at in chemicals, some of it in sugar. Similarly, in our Fenesta and farm solutions business also, we're looking at volume growth. So I think that's the best part, that our growth going forward will be driven by volumes.
And what are the kind of volume growth that you're expecting this year, Amit?
See, I think if you are wanting to understand in terms of revenue, so I feel on a conservative basis, we should see a 10 to 15% revenue growth year on year.
10 to 15%. Similar to last year, you ended FY25 with 11%, and FY26 should also be 10 to 15%. Chemicals is about 20% of your top line right now?
Chemicals would be close to about 25% of our top line.
25. And now with the expanded capacity coming on stream, what is the guidance on chemicals revenues and how much will it contribute going forward? And will there be any change to your EBITDA margins in the chemicals business?
Yeah, so I think in the coming year, majority of our growth in bottom line, a large part of it will be driven by chemicals business. They will form a large part of our profitability. And even on the top line, from current about 20-25%, they will be in the range of 25 to 30% in terms of top line.
Okay. And what would the growth be? You're saying the revenue contribution should inch up closer to 25-30%.
Yes.
And what would the revenue growth and even the margin improvement? Because you're saying that will be the dominant driver for your profitability.
See, I think, as I said, for our kind of businesses, what we look at is how we are growing our business in terms of volumes, because that defines the growth. And the other thing is what we are doing on the cost side. So we have been taking cost side initiatives in terms of power plants, in terms of green energy. I think those are things which are in our control, and that helps our margins. Now, specific to your point on margins, last year, full year, we had a margin in chemicals of about 17% at EBITDA level, and Q4 was about 20%. So given, the way industry is, the way we are seeing trade wars and things like that, I don't think it's right to give what the number can be. But best case, we do expect to be operating in that range on higher volumes, which means higher profitability.
So in that case, Amit, what are the kind of margin targets that you are penciling in? Do you expect to remain in this 11 to 13, 14% range for FY26 as well?
I think so. We should be in that range.
All right. And what about the ECH plant, Amit? There have been several delays, right, with regards to the commissioning of the plant. There were supposed to be trials in the fourth quarter as well,
Yeah.
and expected to be commissioned in the fourth quarter. Where do we stand on that regard?
I think we have completed almost 99% of the project, right? It is just that some equipment is, having some technical issues. Now, somewhere where we invested almost 4 large projects got implemented in last 2 years, I would say, in terms of commissioning. We can have a problem in one of the project, which is can always happen. But we're looking into it, and I think our trials should start now by this month end, and we should be commissioning in early June.
What's the broader outlook for sugar, ethanol, and even the Finesta business? What would be the key milestones the company is likely to achieve in these two segments?
See, sugar this season wasn't very good, given the fact that the sugarcane production was low in the country, and therefore production levels came down. Even the recovery levels came down. So I think there is scope. If you say next year, obviously there is scope for increased volumes in sugar as well. But I think what's important in sugar business is, or industry, I would say, is for the government to look at a holistic policy for sugarcane cultivation, how it can be improved, and also for a better policy for manufacturers, both for sugar as well as ethanol. Although we feel in this year it should be better, hopefully the overall sugarcane production should increase. Therefore, it should be better off. But then, there are a lot of issues like crop economics, climate challenges, diseases. I think these needs to be looked at more holistically for a long-term stability of sugar business.
What about the margins and the top line growth for the sugar business, Amit? Have you set any targets for that?
The sugar business is very difficult to set targets for the margins. It's so sensitive commodity, both on the feedstock side as well as on the output side. So it's difficult, but we do expect margins to be better.
Do you have any exports?
See, exports is driven by how much government allows. It's completely regulated sector, both on the input and output side.
Okay, so what was the export contribution?
Last year, not very significant. I think overall profitability, maybe 5-6 crores would be.
Okay. And is that likely to change this year?
I don't think so, because production levels have been low this year. Inventory levels in the industry have been low for sugar. So I do expect some production, but not very significant.
Now tell us more about your recent acquisition, Amit, the DNV Global, the rationale, the opportunity that you're seeing from this acquisition, and how is it likely to contribute to your P&L this year?
So one, I think we are very excited with this acquisition because it's a new area that we've entered into, which is an adjacent to Finesta, the windows and doors business that we have. Now, currently the way this business acquisition is being looked at is more in terms of backward integration, because it will help us innovate on hardware faster, and it will also help us give better customer experience. So that's the whole objective to start with. Going forward, futuristic, what we look at is this as another vertical or another revenue stream where we get into more innovative hardware, and where we sell it as a product, as a revenue stream direct to customers as well. So it's a bit of a long-term story. I think this will shape up over a period of next 2 to 3 years, but we are very excited with this new entry.
But does it start contributing meaningfully this year, or you'd see meaningful contributions only 2 to 3 years down the line?
Meaningful will be 2 to 3 years down the line.
Right. All right, Amit, thank you so much for sparing time and joining us today. Wish you good luck for the rest of the year as well. The management there of DCM Shriram on their quarterly results and the road ahead for their. Take a short break. More on the markets on the other side.
Welcome back. Gokuldas Exports is now up 16%. It's moved up on very large volumes, now approaching the 4-digit mark on Gokuldas Exports, 990 in terms of a stock price. BSE, Bombay Stock Exchange, also hit a fresh 52-week high. The stock is close to 6,800 rupees. The intraday high today was, I think, 6,847. So it's made a new fresh 52-week high on the back of the Q4 numbers. 10% revenue growth quarter on quarter, 75% on a year-on-year basis. And the company is also gaining market share in the options category. Motilal Oswal here has put a target price of 7,600 and they're valuing Bombay Stock Exchange at 45 times. We spoke about Paytm and how that's a big mover. Another one is Piramal Enterprises. Again, on the back of their numbers, Piramal Enterprises is up close to about, I think, 7%. And in the conference call, the management has guided for a 25% year-on-year growth in the total AUM, primarily driven by growth in the retail loan segment. So good quarter, and the company is guiding for a 25% top-line growth next year. Ather is another big mover. Yesterday, day one of the listing, subdued day, but today it's bounced back. Indian Hotels too, despite good numbers, came in for profit booking, and the stock has rebounded smartly. KFin, Kajaria Ceramics, Parag Milk, IFL Finance are some of the other big movers in the mid-cap space. We leave the Nifty at that 24,350 mark, mildly lower. Things have quietened down on the index. With that, it's a wrap on this show. Thank you very much for watching.